The information presented is for informational purposes only. The opinions expressed are not necessarily the opinions of any Daikin company. This information should not be confused for accounting, legal, medical, or other professional advice. Please seek advice from a qualified professional for any specific questions.
Welcome to the Accelerated HVAC Success program. My name is Ben Middleton. I'm the National Sales Training Manager for the Goodman Amana Daikin brands. Today, we're joined here with Eric Howarth. He is the Vice President of Home Innovations over at Goodleap Financing. Eric, thank you so much for joining us.
I'm happy to be here.
So, Eric, you've been in the HVAC industry for a while, but before you got into HVAC, you were at a little retail company known as Target.
I was
in
retail.
Can you tell me a little bit, what things did you learn while you were at Target that you've kind of brought into the HVAC industry as you've worked with countless contractors and helping them embrace financing and utilize that as a tool to serve their customers?
Well, first of all, work ethic. I mean, retail is a tough game.
Mhm.
It's not a game where you don't work a ton of hours. You get used to working until the job's done. There's goals to hit and sales to hit and product to restock on shelves. So and keeping that product tidy. So I think work ethic was one of them. And I think there's a lot of businesses that actually look for folks out of retail just because of that work ethic when they hire executives and stuff out of retail, because they're pretty much coachable and trainable and just about anything because they're willing to put in the time, just like anything, right? Life's 99% perspiration and 1% inspiration.
I do know in previous conversations you and I have had, we talked about some of the things that you were involved in when you were with Target, talking about rolling out the red card and some of the things that you guys learned, observed as that was being rolled out.
Yeah, I mean, average sales going out. I mean, I think it goes to, what I do now in the sense that it showed me how important financing was as part of the package deal. I think there's a misnomer in the HVAC industry quite a bit with smaller contractors across the board that financing is not important. And I think a lot of retailers even thought that at one time years ago. You go back 30 years. I don't think a lot of them realized how important a card could be in their business model.
Well, there were some of the major retailers of their time. You take a look at Sears and the Sears card.
Yep.
And in fact, for a lot of people, the Sears credit card was probably the first credit card they got, either that or
Mervin's. Or Mervin's.
Right. So, I mean, some retailers really did embrace financing a long time ago.
Yeah. Yeah. And I think you get a lot of repeat customers and whatnot as a result of a card. Of course, a card is a totally different thing than on an HVAC system. I don't know what the average is, 1.5 in a lifetime or something like that. So unless you're selling multiple other items besides just HVAC, I'm not sure revolving credit or things like that are that important. But offering financing up front is important because it is a decision-making factor. Even in retail and transactions as small as, $200-$300, it's important. Imagine when you're trying to sell a $10,000 or a $15,000 HVAC system, how much more important it becomes.
Oh, absolutely. Now, you are the Vice President of Home Innovations, and so you don't just oversee HVAC loans, correct?
No.
You work with a lot of other verticals within the home improvement space.
Yep. Windows, doors, siding, all those.
So how would you say some of those other verticals may be more forward thinking when it comes to financing than many of the HVAC contractor businesses that you talk to?
I think they had to be, because there's a difference between have to haves and want to haves. A want to have is windows. You don't have to have windows. You can just put a piece of glass in the old window. You don't have to. You don't have to have new siding on your house. You could just fix the dry rot in one area. But you have to have HVAC if you live in Houston, where we are right now. You have to have HVAC. So I think the HVAC industry as a whole got lazy, and they got
Hmm.
lazy around the fact that they didn't put it into their pitch up front because they didn't deem it as important, because they knew people had to have their product and they were at least going to end up with a repair, right? Because if it's broken, they're at least going to repair it. You're at least going to make some money on it. If you go in for a window job and you don't sell it, you don't get anything.
Hmm.
You're not falling back on a repair. You're not falling back on anything. So I think other industries were quicker to adopt and become more successful at it than HVAC. But if you look at any large group right now, financing is a key part of their sales and marketing initiatives.
So you mentioned windows, doors, siding. You've also been working quite closely with the solar industry as well, correct?
Yeah, solar is another one where financing's key because every sale actually hinges on whether the financing can, in fact, the marketplace is tough right now for solar because interest rates are high. It
Hmm.
makes it hard to pencil out solar for the cost of solar over the lifetime of the loan. So financing is actually key in solar.
Well, so you mentioned interest rates are high. We are kind of in an interesting period of time right now.
Hmm.
Uh, Interest rates were really, really low. And you and I were talking a little bit before this, and you said something that I thought that was really interesting. You said those rates just were not sustainable. Elaborate a little bit more on that.
Well, uh, those rates were really put in place to, of course, work on an economy that had fallen apart, and the whole idea was to build the economy back up. I don't think that's where um, anybody ever thought they were going to stay or where they
Hmm.
should stay, because it makes it really tough for folks to want to lend money or make money on money. Because the dirty secret about banks and all the other stuff is everybody's like, well, they're making all the money. Well, in the good times, you're right; they have a chance to make all the money. But when things get bad, it doesn't take much for it all to
Right.
go away in a hurry. So the whole idea is that you have a nest egg and you saved if you were a good bank and you put away the times for the ups and downs so that you can do that. Well, it's really hard when you're making very low interest on loans over time to do that, right? It takes a lot longer to put that money away and everything else. So um, I think um, I think, you know, I think a lot of people lose perspective because they don't realize that the whole reason those rates came to be is because of a little thing called '08 and '09 that kind of drove all that stuff down, where everything almost fell apart. And people's memories are short to that. And I've just, I guess, been around long enough to think more long term. So I would say, um, I think they'll settle down lower than what they are, but I don't foresee them going back unless the economy goes to total skids, ever going back to as low as they were. So
So when you look at that, I mean, our interest rates right now are probably more normal than they should be. They may be a little bit
I
high,
think they're a little high
but they're more normal than what we've seen. I mean,
historically.
we've seen much higher interest rates historically.
Yeah. My first house,
Yeah.
12%. So
And so I mean there is a little bit of an ebb and flow that happens back and forth. And we've seen some of the banks. You and I talked a little bit about this too. Some of the banks that have been in financing have had a rough go at it as well, and even had a challenging time as far as their solvency.
yeah, it's tough. I mean, especially when you go to scale in financing, because especially working with the larger groups and stuff, the tendency is to want to win the business. Um, Sometimes no matter what the cost. And then when margins get squished and you can't sell them in the market, and investors are expecting more money for each transaction, and you can't make any money on your transactions, that becomes a problem when you're locked into contracts. So uh, I think I think although it's always good for the market to go through these transitions, I think it's a tough place. A lot of finance companies put themselves in a tough spin. I mean, you can look online to see which ones they are. I mean, across the board, there were a number of companies that they bet on different outcomes,
Hmm.
and instead of just sticking to principles. And I think, but the misnomer in this industry, it might be good if your HVAC contractor next door goes out of business, but in the finance industry, it doesn't work that way. If we have banks or finance companies that don't perform, it just stops up the markets and it makes investors a little more weary of investing, and makes the cost of funds higher for everyone. So it's never a good thing. I just want to beat them all fair and square and have them all in the marketplace,
Right,
so
right.
that we can compete and I can win rather than shake the markets or spook the markets about how well run different finance companies are.
Well, and I think just like anything in life, when you are looking at a company to partner with, obviously cost of the money is one component, but then there's also the customer experience, the ease of doing business with, that all of those pieces are very important as well
Yeah.
in finding the right partner to work with.
Yeah, I think that, and the other thing going back to retail that I learned is customer service, being there
Mm-hmm.
to actually answer the phone. And I put that, I mean, when I don't sell contractors on our program. I sit down with them and say, why are you looking for somebody else? And let's look at the reasons why you're looking for those other folks. And usually, most of the time, I hear, they didn't get good customer service. They
Mm-hmm.
didn't understand. They couldn't get a hold of somebody. Um, they're not getting the approvals they used to get or anything else. And there's two modes of thought there that a lot of finance companies go into. They can either make money by buying deeper, and then that has a cost
Mm-hmm.
associated with it. Or they can just ratchet up your approval rates till they get to the point where you're 30% less approvals than you used to be with the same company, and that happens. But it's not the bank's fault. They got to make money, and obviously, as the economy gets rougher, losses get rougher in the lower FICO score ranges as opposed to the higher FICO score ranges. So in order to offer those lower rates at any kind of a return that makes sense, because I mean, the end all return also incorporates losses. So if your losses are too big, and the higher FICOs perform better. So as you push that spectrum up, we just make it look, we chose to kind of take a middle path where we would buy deeper on the regular, focus on how we followed up with those customers and took care of those customers, and did it at dollar ranges that were high enough to where you could get those approvals. But I don't fault any bank for going after the rates or the lower rates or anything else. That was just a business decision they made at the time. So if they wanted to offer a lower upfront rate and only approve higher FICO scores for that, that's fine. I mean, that's a good choice too. I think you just have to look at your market when you're vetting a finance company and
Right.
decide if you're working Malibu, that probably works for you, right? You got a high FICO scores, lots of property on average, and that could be a good win for you. But if you're working tougher areas of the country where FICO scores are lower and income's lower and debt to income's higher, then that might not work for you, and we might be a fit there. So, like I said, I think you should vet your finance company just like you would uh, your hairdresser or your barber or your or any service that you go to. Do they give you the service they're supposed to do? Are they fulfilling all the needs overall? And you should just kind of rank them in a number score and say, these are the most important things to me. Let's line them all up, and whoever wins wins based on that.
The biggest thing I hear from a lot of contractors when they start complaining about approval rates, typically it's the contractor that's not offering financing 100% of the time.
For the smaller ones, yeah.
Yeah.
And so what happens is they wait for someone to ask. Well, if you're waiting for someone to ask, then they probably have a lower FICO score.
Right.
Yeah. And that's why you see a lot of times when contractors have online links, you'll see the average approved for that are much lower FICO scores because people are embarrassed about their FICO score. So oftentimes they'll go online, they'll go to the contractor's website before, and they'll apply online. And you see way lower FICO scores on online registrations than you will see even in person.
So you work with probably some of the largest HVAC contractors in North America.
Yeah, the largest. Yeah.
And so as you're working with them, what are some of the biggest things that they're looking for in a financing company, and how does that apply to maybe the smaller, the middle sized contractors and smaller contractors that are out there?
I think they should all just do a math equation.
Yeah.
It's if you're looking at it any other way besides just customer service and math, and the math equation should simply be, what is your net margin? How many more deals are you closing per with the finance company? And does that net out better than what the interest rate or the dealer fees are overall? I mean, you just have to do a simple side by side comparison to do it. the problem is most people only look at it as a rate sheet. And if you're
Mm.
looking at your finance company as a rate sheet, then you're probably looking wrong. There's a lot of startup companies out there that are smaller in scope, that'll come and go, that'll offer teaser rates for a brief period of time. But there'll be more headaches, there'll be less approvals. Usually those are based on higher FICO score programs and things like that. There's less predictability in your approvals across the board. And you might be able to, have a finance person or something like that wrangles those programs, but typically they're harder to run with. They require more steps and everything else. If you want any of the mainstream programs, then you want to find whatever mix works best for your company. I mean, and if, like I said, if you work with somebody, if you're working Malibu, uh, you know, you probably have high FICO scores. Maybe you could work with one of the boutique programs that has those higher FICO scores and approvals, and you could take advantage of that because the approval rate's not going to be as important to you, or Bellevue, Washington, or any of those higher FICO score areas.
So you guys offer a lot of different financing products
Yes.
that somebody might utilize or take advantage of. What are some of the trends? Do you see the trends? Are they regional, like you're talking about? You've got some more affluent areas, and then you've got more blue collar areas that may be out there. What trends do you see as far as the programs that contractors have the most success with? Maybe where do contractors get the highest tickets? With are those associated with different programs? What are some of those things that you're seeing out there?
Yeah, I think we're seeing at least on our platform across the board, there's been a drive towards longer term
Mm,
programs to get the payment down and low to no dealer fee programs because now customers are becoming kind of desensitized to the high rates, whereas they used to think that, 5% was a high rate,
mm,
because of their mortgage. I think people are more accustomed again to the higher rates on unsecured and other products. Some people have gone to buy a car and had got an 8% loan on their car that's repoable, right? So I think you're seeing people more conditioned to that effect, and so you're seeing a lot of contractors go for lower to no dealer fees for longer periods of time.
mm.
So, and that way they bring the payment down. Almost all the finance companies out there have um, no prepayment penalties or anything, so the customer can pay it off at any time. So, if the customer just holds on to that loan for 2 to 3 years and pays it off, then they'll pay it off.
So it's really interesting that you say that because I do see a lot of other manufacturers really push on 6 month no interest, no payments, 12 months no interest, no payments, maybe even longer. But I'm not hearing that from you. So what have you found with those type of programs?
Um, I think there's a place for those programs. Those are conditioning your cash buyers that it's affordable.
Hmm.
Let's face it, nobody likes to write a big check.
Right.
So if they got to sit there and write out a big check or watch it leave their bank account, they just don't like it. Some people just like the time. So offering 6 or 12 months same as cash before you offer a fixed rate term loan is a great way to precondition that customer that
Hmm.
they don't have to they don't have to worry about taking it out of their bank account right now. They can wait till their bonus check comes in so they don't have that 15 grand getting onto their savings or anything like that. So that's the whole idea of those programs. Um, but I think as debt to income gets rougher in the country, and we're seeing a lot folks with a lot more debt right now as as inflation really goes up and hits Main Street the way it has. And I think you're seeing those debt to incomes go up. And as the debt to incomes go up, they just need the lower payment just to make it through. And actually statistically, you have a better chance the lower payment you put in front of them because in with a lot of finance companies, they look at debt to income different than we do. So if you are using other finance companies, the longer the term, the better chance you have of hitting those debt to income thresholds.
Hmm.
So a longer term and a lower payment, that extra $40 a month might just put them over their debt to income threshold with that finance company. So,
So you bring up the fact that you're seeing the debt to income ratios go up. What is kind of the state of finance in North America right now?
Well, it's a mixed bag. I mean, I
Okay.
think you see the higher FICO scores getting better, and then you see the lower FICO scores struggling. It's usually equated to income. So
Mm,
you'll see folks with income getting stretched because their dollar's not going as far right now. And, anybody who goes to the grocery store feels it. So just imagine that that's hitting you there, and it's hitting you in your every time you go to the gas pump, or you hit any place else, inflation that's hit. And I think that's where it's making tough for a lot of consumers because then their HVAC goes out and now they got a whole nother bill on top of it.
right.
And so I think contractors need to flip their mindset. A lot of contractors, and you've heard this probably, Ben, as many times as I had, um, I would never take out a 10-year loan for my HVAC.
Right.
I would never do that. I would never take out a 15-year loan. Well, the fact is you're putting your own preconceived notions on your customer.
Well,
And
the fact is, for that contractor, they would never pay full retail price for an HVAC system.
exactly. So I think I think asking the customer, like we talked about, like I do during the vetting process, I
Mm,
don't want any business that I can't earn and it's not the right thing for me to have. And so you should do that as part of your vetting process with your customer the same way. Ask them what they need and stop putting your own preconceived notions on the customer. I mean, if customer might need a low monthly payment, doesn't mean they need it forever. They might get a bonus check every year that's big and they can pay it off in 12
right.
months. But they may not want to. They may have already something planned for that money and they want to go out longer. So let them pay it off in 2 or 3 years. The secret is, even if they take out a 15-year loan, this dirty secret is it's not going to 15 years. They're paying it off in 4 to 5 years.
So, just talking about, contractors, you've made a pretty big investment in your team
Yeah.
in order to give that customer service. So how many people does Goodleap have that are covering the United States today, to be able to help HVAC contractors figure out how to
W-
offer financing and deliver that?
We have over 100 in the field. So over 100 just in the field. So, and then we have an 800 line. We found that touch is just really important, especially for in so many instances, that just being able to reach out and spend the time with the contractor, not just through a Zoom and not just showing up, once every 2 years
Yeah.
to say hi, as makes a difference because you can have some dialogue and a talk with the contractor and everything else. So we made the investment in the team to do that. It's not typically how financing's been done, but we did it because of our customer base, the manufacturers and distributors like Daikin that we work with, and the distributors at Daikin. A lot of the TMs need that time with someone so they can understand. Nobody wants to sell anything they don't understand, and the only way you can teach them is time.
So it's pretty easy. If a contractor wants to work with one of your team members, they can reach out to one of our territory sales
Yeah,
managers. They can come out with one of your team members, meet at the contractor's office,
yeah,
and talk about how they can best implement financing into their own business.
for sure. I mean, the only thing, of course, we'd always ask that is if we go out with a TM that there's multiple appointments,
Right,
right?
right.
So if I'm driving them out there or anything else, but if they're local and they're really close, which most people, the way we're situated, we can get someone there usually within an hour plane flight of anywhere. That's the way we're pretty much situated across the country now. So pretty quick turnaround.
Eric, just as we look at what's happening, I know you and I are talking right now. Probably after this airs, there's going to be some announcements that the Fed has. What are some closing thoughts or words of wisdom that you want to share with our contractors in terms of getting their financing strategy right in this current time and place that we're at?
I would say, um, just learn to vet your finance company correctly. If you're just looking at a rate sheet, you're doing the wrong thing, because oftentimes that rate sheet could be a fixed rate promo that might be a lower interest rate. Like some people are going with interest rates at 9.9 across the board,
Hmm.
saying, no dealer fee at 9.9. but only 760s and above are getting approved, or 800s in some cases and above are getting approved. So then it's converting back to a 13.9 interest rate or a 14.9 interest rate for some customers. So it's still risk-based pricing. So you just want to ask questions and vet. And like I said, there are scenarios where that works out really good for you because you have a lot of high FICO score folks in that area, and it might make sense for you to have that rate card. But just do your due diligence. So learn how to vet and do the numbers. Figure out where your gross margin is. Figure out your approvals. Figure out what you're missing out on, and then do the math and the difference in dealer fees. Don't just shut someone down because of dealer fees or anything else. Just do the math. That's all.
Well, Eric, thank you so much for joining us. It's always a pleasure having you here. And for all of you that are out there, if you like this episode, please hit that like button. Also, make sure that you follow us so that you can be informed of all of our upcoming shows. And we look forward to seeing you on our next episode. Eric, thank you so much.
Great seeing you, man.